Hi, this is Andy Filipiuk in Toronto for the week of August the 14th. This week I'm going to deal specifically with the preferred share market. In our Canadian permanent portfolio, we have a 15% weighting in the Lysander Preferred ETF. Now, the reason we moved into this several years ago is as a hedge against rising interest rates. And what I'll do is I'll explain briefly how the preferred share market in Canada works and why we're in this preferred. Roughly about 2 decades ago, most Canadian preferred share issuers started doing what are called reset preferreds. They would issue a preferred share at 25%. The issuer had the option after 5 years of either resetting the rate at the existing 5-year Canada bond rate or redeeming the preferreds. Now, at the time, these preferred shares, almost 100% were redeemed, and then they'd reissue a new 5-year. Now, the specific structure was on the issue at $25 per share, they would set a fixed reset rate, let's say 2.5%, and then at the time of closing, they would pay the 5-year Canada bond rate. So, for example, an issue 20 years ago may have paid 2.5%, plus you add on the 4%, say 5-year Canada bond rate, which give a 6.5% dividend yield. And as I mentioned, brokers would sell these preferred shares after 5 years, they'd be redeemed, and they'd issue a new preferred with another 5-year reset term. Now comes 2009, when we had the financial crisis and interest rates were dropped to zero by the Federal Reserve in the US and by other central banks globally. As a result, 5-year bond yields dropped precipitously. In Canada, we went down to 1% or even lower at a time. So, surprising many in the preferred share markets, the issuer of these resets, instead of calling them in and reissuing a new bond, basically said, no, we're not going to call them. We're going to issue, or we're going to reissue at another 5 years at the existing 5-year bond yield. So buyers of these preferreds who are used to say 6.5%, were suddenly getting say 2.5% reset plus 1% on the 5-year Canada, and we're now getting 3.5% instead of the 6.5%. So the price of these preferred shares plunged. And as a result of it being a very illiquid market, the shares sort of, if they were issued at 25, a lot of them went down to 18, 17, 16, and have hovered there ever since. Now, in the last several years, we went into this Lysander preferred share because the preferred shares had dropped so much, the yields were looking reasonable. And one of the benefits of this preferred share or the preferred share market now is that as interest rates go back up, and I've talked about this in video after video, now these reset preferreds are going to be reset at much higher rates. For example, the 5-year Canada bond just since the start of 2022 has gone from 1.6 to 4%. Now, I've included with this video 5 preferred shares that Doug Grieve, who's the manager of the Lysander Preferred, sent to me earlier this week. And I'm going to highlight specifically one of them, the Trans-Canada Preferred D. Right now, it's trading at $15.25 approximately. It has a reset value of it's going to pay 2.38% when it resets, which if you go to the far end of the chart is April 30th of next year. So within 8 months, this is going to be a preferred share that's going to be reset. Now, it's paying a 6.13 dividend yield 6.42% dividend yield currently. With the 5-year Canada at 4% now, if this rate doesn't change, we will be getting a 10.49% on this preferred in 8 months. Now, as I mentioned, these preferreds can be called by the issuer, but with the preferred trading at $15.25 approximately, if they were called this at $25, we'd be making close to a 40% capital gain in 8 months if they did that. So that's not a concern to us. Now, talking to Doug, we have in this preferred ETF, 37% of the preferred shares in the fund are going to be resetting next year, and then the following year is 15%. So over half of the portfolio is going to be resetting over the next 2 years at much, much higher yields. And this is, again, why I added this preferred share, which is currently a 15% weighting in the fund over the last couple of years to hedge rising interest rates. So I think we're going to see in the next year or two, because of the tremendous mispricing in this preferred, a substantial rise in the value. In fact, over the next couple of months, I intend to, because we have the flexibility within the portfolio, to take the weighting of this from 15 to 20% to try to capture a higher rate of return, we'd be moving it from the 25% weighting in short-term bonds. We'd reduce that to 20% and increase the preferred from 15 to 20%. Now, I've said a lot in this video. If you have any comments or questions, please let us know. But we are really trying to hedge this scenario, which is rising rates and potentially higher rates for longer. And this preferred share within the Canadian permanent portfolio, I think, will help tremendously get us higher yields and hedge the value of the portfolio nicely. Thanks for watching.